Imagine a world where your money works for you, even when you're sleeping. Welcome to the world of dividend investing. Now you're probably wondering what's so special about dividends. Well, let's break it down. Dividends are essentially a portion of a company's earnings that are distributed to its shareholders. It's like receiving a slice of the company's profit pie, and who doesn't love pie? The beauty of dividends lies in their potential benefits. One of the most attractive aspects of dividend investing is the steady income stream it can provide. This is especially appealing for those who are thinking about retirement or are already in that stage of life. Imagine having a consistent income flowing into your account, all from the comfort of your home. It's like having a golden goose that keeps laying eggs, except these eggs are cold, hard cash. But the benefits of dividends don't stop there. When dividends are paid out, you have the option to reinvest them, buying more shares of the company. This is a powerful tool for wealth accumulation, as it allows your investment to compound over time. It's like a snowball rolling down a hill, growing bigger and bigger with each roll. And here's another interesting fact. Dividends can often outperform the market over the long term. This is due to the compounding effect mentioned earlier. Over time, the returns from dividend investing can accumulate to a significant sum, often surpassing the returns from simply buying and selling stocks for a profit. So, whether you're a seasoned investor or just dipping your toes into the investment pool, dividends can offer a multitude of benefits that can help secure your financial future. Intrigued yet? Stick around as we dive deeper into the world of dividend investing. So, what exactly is dividend investing? Let's break it down. Dividend investing is an investment strategy that centers around buying stocks or mutual funds that pay dividends. But what exactly are dividends? Well, when companies make a profit, they have a decision to make. They can either reinvest this profit back into the business, or they can distribute a portion of it to their shareholders. This distribution is what we call a dividend. Now, these dividends can come to you in two main ways. The first, and perhaps the most straightforward, is a cash payment. The company will simply transfer the dividend directly into your investment account. This is like getting a little thank you note in the form of cash just for owning the company's stock. It's a way for the company to share its success with you, the investor. The second way you might receive a dividend is in the form of additional shares of stock. This is often referred to as a stock dividend or a dividend reinvestment plan. In this case, instead of receiving cash, you receive additional shares in the company. This can be a great way to gradually increase your ownership stake in the company without having to buy more shares out of pocket. And here's the best part. You can choose to spend your dividends, or you can reinvest them back into buying more shares. The latter option can create a snowball effect where your dividend earnings help you buy more shares, which in turn can potentially earn you even more dividends. This is the power of compounding at work. But remember, not all companies pay dividends. Some choose to reinvest all their profits back into the business for growth. So, if you're interested in dividend investing, you'll need to look for companies that have a history of paying dividends. With dividend investing, you're essentially getting paid to own a piece of a company. How cool is that? Now that we understand what dividend investing is, let's explore why it can be such a powerful investment strategy. One of the most appealing aspects of dividend investing is the potential for consistent income. When you invest in dividend-paying stocks, you're essentially purchasing a stream of income that can supplement your regular earnings. This can be especially beneficial for retirees who need a steady income flow, or for anyone looking to diversify their income sources. But that's not all. Dividend investing also harnesses the power of compound interest when you choose to reinvest your dividends. When you reinvest, you purchase additional shares of the stock, which in turn generate their own dividends. This cycle can lead to exponential growth over time, a phenomenon often referred to as compounding. Albert Einstein once called compound interest the most powerful force in the universe, and for good reason. Over time, the effect of compounding can significantly enhance your returns, helping your money work harder for you. Finally, dividend investing can potentially lower your investment risk. This is because dividend-paying companies are often more established and have a track record of generating consistent profits. These companies are typically more stable and less volatile compared to growth-oriented companies that do not pay dividends. As a result, investing in dividend-paying stocks can provide a degree of protection in volatile or declining markets. Furthermore, dividends can provide a cushion against losses. If the market value of a stock falls, the dividends can help offset some of these losses. This makes dividend investing a more conservative strategy that can help preserve your capital in uncertain market conditions. To sum it up, dividend investing offers several compelling benefits. It can provide a consistent income stream, harness the power of compound interest through reinvestment, and potentially lower your investment risk. Whether you're a seasoned investor or just getting started, these advantages make dividend investing a strategy worth considering. From providing a steady income to lowering your investment risk, the benefits of dividend investing are hard to ignore. Convinced about the benefits of dividend investing? Great! Now let's discuss how to get started. The first step in your dividend investing journey is research. It's crucial to understand the companies you're investing in. Look for businesses with a history of stable earnings, good prospects for future growth, and a track record of paying dividends. It's also essential to understand the company's dividend yield, which is the annual dividend payment divided by the stock's current market price. A higher yield might be attractive, but it's important to balance this with the overall stability and growth potential of the company. Choosing the right stocks is the next important step. While it might be tempting to go for the highest yielding stocks, it's often more beneficial to choose companies that have a consistent history of paying dividends. These are usually mature, stable companies in sectors such as utilities, consumer goods, or healthcare. A diversified portfolio of dividend-paying stocks can help to mitigate risk and provide a steady income stream. Once you've selected your stocks, the next step is to decide what to do with the dividends. One of the best ways to maximize growth is to reinvest the dividends. This can be done by purchasing more shares of the dividend-paying stock, thereby compounding your returns over time. Many brokerage firms offer dividend reinvestment plans, or DRIPs, which automatically reinvest your dividends into additional shares. However, before diving in, it's always a wise idea to consult with a financial advisor. They can provide personalized advice based on your financial goals and risk tolerance. Remember, investing always involves some level of risk, and it's important to be comfortable with the amount of risk you're taking on. Successful dividend investing involves thorough research, selecting stable dividend-paying stocks, reinvesting dividends for compound growth, and seeking professional advice if needed. With some research and a solid strategy, you're well on your way to becoming a successful dividend investor. So, we've covered a lot today about dividend investing. Let's quickly recap. In the realm of investing, dividends have a power all their own. These regular payouts from companies can provide a steady stream of income, separate from any potential capital gains. They're like a company's way of saying, "Thank you for being a shareholder, here's a piece of our profits." Then we dove into the heart of dividend investing. It's not just about picking any company that pays dividends, it's about finding those with a history of consistent payouts and a strong financial footing. It's about understanding the difference between dividend yield and dividend growth, and knowing which one aligns best with your financial goals. We also highlighted the benefits of dividend investing. Beyond the income, dividends can offer a buffer against market volatility, a hedge against inflation, and a means to grow your wealth over time. But remember, as with any investment, there are risks involved. That's why it's crucial to research and diversify your portfolio. And then we touched on getting started. It's not just about having money to invest. It's also about having the patience and discipline to stick with your plan. It's about reinvesting those dividends to take advantage of compounding, the process where your dividends earn dividends of their own. It's like a snowball rolling downhill, growing bigger and bigger over time. So, there you have it. A quick rundown of what we've covered today. Dividend investing isn't a get-rich-quick scheme. It's a strategy for those who prefer a steady, long-term approach to wealth building. And as always, it's important to do your own research and consider seeking advice from a professional before diving in. Remember, with dividend investing, your money can work for you. So, why not give it a shot? Thanks for watching, and don't forget to subscribe to New Way Finance Academy for more financial wisdom.